So Bitcoin has so far had a history of diminishing returns, still high returns, but diminishing returns. That every cycle, if you take the cycle high and do a multiple of the prior cycle high, or you do, say, the cycle low to the cycle high, there's a couple different ways to measure how big a cycle is. But according to most of them, you've had diminishing returns. One of the surprising things, or kind of a consensus breaker, would be if you get a cycle that is higher than a prior cycle. That's never really happened before. And I'm still agnostic if that's going to happen this time or not. But one of the if it does happen, one of the factors that I think would be relevant for making it happen is
as we explore the intriguing world of Bitcoin in this video. The price of Bitcoin has risen to $66,750 as of the recording of this video, which is its highest since November 2021. This latest surge is mostly the result of MicroStrategy's newsworthy declaration that it had acquired 3,000 Bitcoins for an overall value of $155 million. There is a tangible sense of excitement among traders, as many believe that Bitcoin will surpass its previous all-time high of $69,000 in March. Lyn Alden delves into the significant influence of Bitcoin ETFs on the current bull market in this fascinating discussion with Joe Burnett. Alden sheds light on the historical trend of diminishing returns in Bitcoin cycles, noting that despite past successes, each cycle has seen a gradual decrease in returns. The macro analyst talks about the possible game changer that may occur if Bitcoin were to deviate from this well-established trend and reach a cycle that surpasses previous highs. Alden conjectures about the function of exchange-traded funds, ETFs, in magnifying a bull market, highlighting how their presence expands the reach of Bitcoin and may even increase its influence over past values. As we present to you rare snippets from Lyn Alden's knowledgeable interview, she offers her insightful opinions and analysis on Bitcoin, ETFs, and the fascinating dynamics reshaping the cryptocurrency scene.
So I think the first month or so was about as expected, which is that you had a lot of rotation out of GBTC, a lot of trapped money got out of the higher fee product and got into these lower fee, more reputable products. And so you saw basically this rotation of a lot of pent up demand to get out of one product into other products. So that was normal. And that kind of, you had net inflows, but not overwhelming the first month. These last 2 weeks have been more interesting because you've had the GBTC outflows slow down while inflows are still quite strong. And so now you've had better net inflows. Now we could pause again for a little while because my understanding is that there's a handful more big bankruptcy entities that are going to probably have another wave of GBTC rotations. But overall, I think the sustained duration's been interesting. And talking to some of the large institutions and asset managers in the space, these things do take a lot of time. There's multi-month review processes among some asset managers before they consider letting a new product into their mix. There's also, even the large institutions that are issuing these products don't necessarily go to every client on day one and say, here's this new product. They have kind of a phased rollout that they do. So I think that the overall momentum's good. It's probably a little bit better than I expected, but still generally within the realm of I expected. And overall, I still generally view that this upcoming bull market, if it happens, and it's already been happening arguably, but if this more sustained bull market occurs, my base case is that it was going to occur anyway, and that the ETFs are more likely to amplify it rather than be the cause of it. That basically, once Bitcoin's all-time highs, more people say, hey, maybe I should get Bitcoin. And then ETFs are one more vehicle that they now have available to them. There's certain pools of capital that could not buy it before that now can. And so I think overall it's an additive effect more than a causal effect. But so far it's been quite constructive. As Bitcoin gets to higher layers, it has to reach into more types of capital. Right. So if there's just say $30 trillion in managed assets that just can't touch Bitcoin and it's in these walled gardens, then that kind of limits what Bitcoin reach in a given cycle, right? Because those assets are not going to come out of those walled gardens. And so to the extent that Bitcoin can penetrate into those walled gardens, that's relevant. So Bitcoin has so far had a history of diminishing returns, still high returns, but diminishing returns. That every cycle, if you take the cycle high and do a multiple of the prior cycle high, or you do, say, the cycle low to the cycle high, there's a couple different ways to measure how big a cycle is. But according to most of them, you've had diminishing returns. One of the surprising things, or kind of a consensus breaker, would be if you get a cycle that is higher than a prior cycle. That's never really happened before. And I'm still agnostic if that's going to happen this time or not. But one of the if it does happen, one of the factors that I think would be relevant for making it happen is the ETFs. If there's something that helps us surprise the upside, I think last cycle surprised most people to the downside. Like the high was not quite as high as some people were hoping. The low was lower than people were hoping, even though it was a much higher high and a much higher low than the cycle before it. But if you were to kind of surprise to the upside in a cycle, I think ETFs are one of the major variables that would probably enable that.
A lot of traders think that March will see Bitcoin hit a new all-time high. A number of variables are driving this optimistic view, such as the market's growing fervor, institutional purchasers' increased desire, and the historical profits associated with the Bitcoin halving event. The halving, which happens about every 4 years, lowers the incentives that miners receive. In previous years, this occurrence has caused significant price increases in the months that follow. Mid-April is anticipated to see the next halving. Prices usually rise as fewer new Bitcoins are released into the market, particularly if demand keeps rising or stays constant. While historical patterns are not usually repeated, investors are frequently motivated to make large Bitcoin purchases due to the expectation of a rise. But Lyn Alden presents a more complex picture. She contends that although the halving is significant, its immediate effects could have been overstated. Alden contends that changes in demand and liquidity throughout the world have a greater overall impact on Bitcoin pricing. She also emphasizes how important it is to understand the tactical risks related to Bitcoin. A lot of investors ignore its complexity. Let's go back to our conversation with Lyn Alden so she may explain her viewpoint.
I think it's oversold in the near term. Like, there's no strong correlation between the halving and, say, 3-month price action. Sometimes the bull market's already underway before the halving starts. Sometimes the bull market happens after the halving. It's a fairly small percentage of volume overall, and changes in demand can matter a lot more. Where I think the halving really matters is actually over the longer term. Obviously, if Bitcoin did not get more disinflation over time, the price would be much lower. If there were still 50 coins coming out per block, that would be huge. You'd have to have a much lower price in order to absorb the amount of issuance coming. And so it's certainly relevant. And I think the main thing is actually the higher lows in each bear market. The halving is really important for that, because at a time when there's no new marginal demand for Bitcoin, there's some buyers getting out of Bitcoin. The fact that hodlers can basically absorb the supply as the price gets cheaper, they can buy more coins, and now there's fewer coins coming to market than there were in the prior cycles. That's really relevant for having a higher price floor in bear markets. And so I think overall the timing is overdone in terms of narrative, but then obviously the importance is still really there. And I think this is still to some extent affects the timing to a moderate degree. I just think that overall global liquidity indicators tend to be more correlated with Bitcoin price, which makes sense because, the halving determines, a couple $1 billion worth of annual issuance at current prices, whereas changes in demand can affect hundreds of billions of dollars going in or not going in a given year, for example. And so I think that's a much bigger factor for timing, but I think the halving is a really important, one, it's important for narrative, and two, it's important for the higher highs and higher lows in each cycle. I think a lot of people in the space don't necessarily pay attention to the technical risk to the way that they should. And that's also why I don't view Bitcoin as risk-free or recommend like 100% allocations to it, because when you get a very different picture when you talk to developers than when you talk to people that are less technical, right? And to some extent, it's their job to worry. We should be worried if they're not worried, is a good way to look at it. But there's a lot of complexity under the hood. And that's also going back to one of our earliest points we talked about in this discussion, the importance of keeping Bitcoin simple, because it reduces the number of things that can go wrong. So, in 2018, there was an unintended inflation bug that was fixed before it was exploited. You can imagine a scenario where that was exploited before it was fixed. And maybe that doesn't kill Bitcoin, but maybe that sets Bitcoin back 10 years. Maybe that damages the reputation of Bitcoin so thoroughly, even among some long-term proponents of it, that say, well, I don't really trust Bitcoin code anymore, for example. Or how do I, that in some ways it's an anti-fragile system, but that's only up to the point. It's like what doesn't kill you makes you stronger, but you still have to make sure you don't get killed, right? A bullet to the head does not make you stronger. And so I think that there are still tail risks associated with Bitcoin code that should be taken seriously, and that you want to make sure you have plenty of developers looking at the code, reviewing the code before every updates, that are being very conservative with updates that they make, and that people are kind of purposely slow to update to make sure that, they're not just jumping into either just new normal upgrades or flashy new things. And so underneath the surface, there is still technical complexity even though we want to minimize it as much as possible. As users, the developers want to keep it as simple as possible, robust as possible, but that's still something that has to be considered. And that's different than, say, gold, for example. Gold, you have gold in your house, it's not going anywhere. Whereas Bitcoin relies on the internet, it relies on the underlying code working. It relies on a handful of things that continue to go well. So it's in some ways, it's a more aspirational technology. It's a more optimistic technology. And that does come with certain risks along the way.
During our conversation, Lyn Alden offers a meaningful analysis of the Bitcoin halving and its importance in her closing remarks. According to Alden, there has been a slight overestimate of the impact of the halving in the short run. She notes that the price movement of Bitcoin over the course of 3 months and the halving don't strongly correlate. Bull markets can occur at any moment. They can even begin before or after the halving. In the long run, Alden notes, the actual significance of the halving will be revealed. Higher lows during bear markets are mostly the result of it. Hodlers take up the supply, adding additional currencies to their collection when prices decline, when there is no new demand for Bitcoin and some investors are pulling out. This trend facilitates the establishment of a stronger price floor during bear markets, since fewer new coins are entering the market than in prior cycles. While Alden acknowledges the narrative importance of the halving, she suggests that its overall impact on timing is somewhat overdone. She emphasizes that global liquidity indicators are more correlated with Bitcoin prices, as the halving only determines a fraction of the annual issuance compared to changes in demand, which can affect much larger sums. In addition, Alden emphasizes how important it is to understand the tactical dangers connected to Bitcoin. She emphasizes that there is danger associated with Bitcoin and that investing all of your money in it is not advised. Using an inadvertent inflation fault from 2018 that was corrected before it was abused, Alden expresses worries about the intricacy of Bitcoin's underlying code. She emphasizes the significance of cautious user adoption, conservative upgrades, and thorough code reviews in order to reduce technological risks. Alden essentially ends by pointing out that although Bitcoin is an exciting and promising technology, it also has a unique set of dangers and problems that need to be carefully considered and treated with caution. Don't forget to like and subscribe for more videos like this. Until next time, happy investing.